Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
Democratic capitalism is the worst system ever tried, except for all the others that have been tried. What we have to remember is there is no better system with which to replace it. And that's important. So what do? We should focus on improving what we've got. Let's make sure regulations are fair. Let's make sure competition is working. Let's make sure political donors and others with large amounts of sway don't have undue influence on the way our markets operate. Let's make sure that people are looked after. Let's make sure there's an appropriate safety net for people who need that support, who simply can't make it on their own. We're a mature, wealthy, caring society. We need to look after those people. Doesn't mean capitalism is broken. It means it needs to be fixed, not replaced. That's the important bit.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. In this episode, I want to repeat 3 words from today's guest. Invest, add, wait. That's it. We could end the episode there, Scott. What do you reckon? There's nothing else to say, is there really?
You know what? The other one I've gone with, the longer I've done this, the shorter my advice is. The other one is Aesop was right. The tortoise and the hare is the thing, right? And so whether you're invest, add, wait, or Aesop was right. Honestly, and the other thing is nothing new in investing has been really kind of designed, invented, codified since kind of Ben Graham in the 1930s. So yes, there's different applications of it. Yes, there's different ways to explain it. There's not much new under the sun, mate, that's for sure.
Okay, well, thanks very much for coming on and we'll see you next time.
My pleasure.
But we could end the episode there, as I said, but then we'd miss out on a scintillating conversation with investment guru, Roosters tragic, and observer of political clown shows, Scott Phillips from the Motley Fool. So normally at this point, I would introduce you, but I think our listeners do know you. But instead, I'd like to point listeners to your entertaining X account. We don't need to say Twitter anymore, do we? It is X, which is humorous, provocative, and fun. How do you deal with the people who take you seriously on that?
Mate, it's a fun exercise, isn't it? My problem is, mate, I'm an investor by trade. I live and breathe this stuff, but also I think we each have a responsibility to the greater good, to the public good, to policy, to other things. And so because I kind of can't help myself, I figure that it's worth kind of trying to be some sort of voice for something reasonableness. That's probably the best thing I'd go for. I have no lofty ambitions other than to try and kind of call out the rubbish and as I say, have a bit of fun along the way. So plenty of opinions. What I do appreciate is on X or Twitter, you get the followers you deserve, generally speaking, not always true. And I'm white and male, right? So I have much less of the trolling that people of colour or women get. But generally speaking, even though I have lots of followers with very different opinions to each other, as long as you engage respectfully and thoughtfully, you generally tend to be able to kind of get a decent sized tribe together. So I'm pretty happy with that and pretty lucky that I've got some good followers. But yeah, it can be either a cesspit or a source of great mirth, depending on how well you do it.
It's just great, I think, to have conversations which point out the failings of all sides of politics. You know, no one's perfect. And there's policy missteps from both sides of the aisle, aren't there?
Of course there are. And honestly, and by the way, some bouquets as well as the brickbats. If they're doing something good, I try and do that as well. But yeah, you're right. I think that's the challenge, right? Is to bash past the partisanship, the so-called rusted-ons, as people call them, to get to the actual issues themselves. And every now and again, someone says to me, "Get off the fence, pick a party." I was like, "No, I'm not going to pick a party. I'm going to give my thoughts on policy, and then at election day, I'm going to weigh them up and say, well, which one do I like least worst? You know, which one is not going to go last?" And that's kind of how I think we should have those discussions and debates, because constructive disagreement's how things move forward. If we're all agreeing, no one's thinking, and if we're all shouting at each other, no one's minds are changed. And I don't know expert, I'm no great psychologist. I just figure if we do things respectfully and reasonably and try really hard to base it on the basics of the policy. By the way, it crosses over to investing too, right? Get rid of your biases, keep them aside, just focus on what actually matters, what you're actually seeing. It's really hard to do because we're not built that way as humans, but to the extent you can do it, I think it's well worth trying to do.
Respectful conversations are the key. And I think just one of the mistakes that I used to make and that I've seen other investors mistake is putting too much weight into who's going to win an election, because in the long run, it really doesn't matter, does it?
No, it doesn't. I mean, I've said the same about Donald Trump.
From an investing point of view.
That's right. That's exactly the point, right? So you have to have two parts of your brain. One part is the part that does care about policy and does want to improve things and whatever way you lean, right? I'm not saying I have the only answer. I try and say, okay, well, I think this policy is good or this policy is bad. Separately to that, to your point, I mean, my investing horizon, Phil, is 5+ years. I have always, since I started, since I very started, I was I was an idiot when I first started. I had to learn a few things. But once I kind of codified what I was doing, the last 25 plus years, 5 plus years has been my horizon. Now think about an Australian political term of 3 years. Think about, a presidential term of 4 years, and they have their midterms every 2 years. And so whatever you think of Donald Trump or Anthony Albanese or Peter Dutton or anybody else, by the time your thesis plays out, or the time frame you're investing on, or at least I am, none of those people are going to be in their current terms. That doesn't mean they can't have second or third terms, but the long-term trajectory of the stock market is not going to be swayed meaningfully by a political term or two. In fact, in the US, there's been research done by Morgan Housel, who's a wonderful writer, and basically showed that the party of the president had no bearing at all on the stock market over that period of time. Sometimes it was good, sometimes it was bad from both parties. There was nothing statistically significant about the party in power and the way the stock market went as a result. And so, yes, you're absolutely right. Bringing your political biases to your investing is almost certainly going to lead you astray.
So how are you enjoying the volatility currently roiling markets?
So I've got two answers to this, Phil, and it's a really important one because we got a lot of members at the Motley, Phil, and for me personally, volatility is a massive opportunity and it doesn't faze me at all. Now, that's not because I am someone who enjoys pain. It's not because I don't care. And for our members, it's really important that I don't come across as, or for your listeners, as saying, who cares if people are losing money? I don't care if your portfolio's down. Sucks to be you stuff. That's not the approach. What I have is a very, very strong conviction that the share market's long-term direction is up and to the right. In other words, things get better over time. And if you have that view, and that could be mistaken and misplaced, but it hasn't over the last 120 years, and I don't expect it to be any different soon. If that's your view, then you can only see volatility as just the wiggles that happen when over the long-term time horizons that fade when you look over a longer period. And so on that basis, firstly, it doesn't matter that share markets are volatile, at least not to your long-term returns. And secondly, it actually provides you with opportunities if you can keep that long-term potential in mind. And so, hang on, I think this company's worth twice what it's worth now. I just pick a number, it doesn't matter. And yet the shares are down 10%. Well, hang on, I've now got 110% upside, rather just a double. And so if your long-term view is that market will be much higher over 5, 10, 15, 20 years, and you get a chance to buy shares because the market's currently offering you a discount, that's the way you should see it, right? It's the pair of jeans on sale. Just because a pair of jeans on sale in the shop doesn't mean your jeans are worth any less than the ones you own in your cupboard. It just means that the price is temporarily lower. And that's the important. Now, it's not easy to do. I've been doing this for a very long time, and I've developed it over time, and I don't expect your listeners to have all got to that point. Some never get to that point, by the way. But once you've really been through enough as an investor, you've had enough experience, and you've absorbed the lessons of the past when it comes to the value creation that share markets offer, and the long-term value creation, you really start to see the short-term is just, again, speaking of Ben Graham, Warren Buffett talked about the Mr. Market parable. The Mr. Market can be either really excited or really pessimistic. He's not going to determine the value. He's just offering you a price. And our job, our choice, our opportunity is to take advantage of unusually high prices if we want to sell something, or unusually low prices if we're in the market to buy.
Mm. And we can always bring out all of those hoary old chestnuts, and the other one is, I think, the share market's the only store that all the customers leave when there's a sale on.
I love that. It's great. It's so true too.
Yeah. Yeah, so, it's very difficult, though, to explain to listeners to be patient and to take these kind of opportunities. There's so much fear involved in it. Are there any little tips you've got for dealing with the psychology of the fear in the markets that we're feeling, especially right at the moment?
Yeah, mate, the best one, I may have mentioned this last time we chatted, Vanguard produce an index chart every year. It's normally released about August, and it's literally called the Vanguard Index Chart. You can Google it, you can find it. Vanguard's website has it. I've written articles about it because I think it's so important. And what it shows is 30 years of history. They advance it 1 year every year, so the last 30 years, every 12 months kind of gets advanced a bit. And it really shows you the long-term value creation of the market. But what I love about it is not just that chart, which is impressive in itself, but they also overlay it with political terms we've just talked about, but also big world events. And so if you go back to the one they released last year, this year's obviously isn't out yet, I haven't got to August, $10,000 became $130,000 on the ASX over that 30-year period. And that was a 13-fold return in 3 decades. And that's despite all things that happened. Now, last year was 2024, so 1994 is where that chart started. So think about the dot-com crash, think about terrorist attacks in the US and Bali, think about the war in Ukraine, think about the GFC, think about the COVID crash, by the way, is already in that data. All those things happened. I think one of the Iraq wars maybe was still in that period. I'd have to double check my timing. I'm getting old, mate, so everything feels like it was recently, but it was all a long time ago. For those 30 years, the market went up 13 times in value, not in the absence of these things, but despite the things actually happening. If we said in 1994, look, there might be a war in Iraq, another one in Ukraine. There'll probably be 2 or 3 terrorist attacks. There'll be at least 3 big market crashes, .com crash, the GFC, the COVID crash. There'll be a once-in-a-century pandemic. There'll be changes of government. Australia will have 84 prime ministers in about 4 years, or at least that's the way it seemed at the time, with the kind of Turnbull, Rudd, Gillard, Morrison kind of years. All of that actually happened. So it wasn't like we had a great 30 years because all those fears weren't founded. They absolutely were well founded, and yet the market did well. And if you can internalize that, then what you can see is every time there's a scary headline in the Financial Review or the Herald or the Age or the Courier Mail, you're going to look at that and go, that's right, this happens regularly. I've seen that before in the chart. I can see where the COVID crash was and the recovery since. I can see the long, grinding 16-month GFC and the recovery. I can see the NASDAQ fell 85% during the .com crash and then recovered to go into new heights and new heights and new heights on top of that. And that's the long-term perspective that if you can internalize, it helps you put any current or potential risks into perspective. And again, it's not easy, not simple, but that's the best way I've been able to do it myself, mate, is to kind of go, okay, this sucks. During COVID, I invested money in February and March of 2020, right as the market was falling. Now, by the way, I got some wrong. I invested in Webjet in late February because I thought, oh, this COVID thing won't be a big deal. That was a silly mistake, obviously, but I kept investing after that. Not because I wanted to, not because it was fun to see 38% of the ASX value wiped off in a month. It was scary, but I literally had, speaking of 2 parts of my brain, the one part of my brain which is, I'm scared, this is emotional, get me out of here, I want to stop the pain, make it go away. And the other part of my brain which was, I knew you'd feel like that. You're going to keep investing anyway because you decided before this you would do it, and you know that history says, and unless this is the first year of 120 where history doesn't continue on the same path, the future will be brighter. Human endeavor will continue. People will find new and better ways of solving new and old problems, old needs and wants. That's kind of what capitalism does. It gets a bad rap because of the extension of crony capitalism or kind of, the hyper capitalism in some places. But capitalism, lowercase c, which is just the incentive for people to go and do things that make other people's lives better, that remains as strong as it ever has in my view, Phil. And that's why I'm super confident that whatever volatility we're going through, both that very concept and a look at the Vanguard chart are the 2 best ways I know to stay on the straight and narrow.
Super is one of the most important investments you'll ever make. But how do you know if you're in the best fund for your situation? Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
Do you think capitalism is getting a bad rap at the moment and they're not understanding the value that it's created in our lives to a certain extent?
Oh, massively. Yeah, massively. And it's 2 reasons, mate. People see the misuse of what I call crony capitalism. So the market actors that are taking more than their share, or the market actors that are persuading governments to regulate in a particular way to advantage them and disadvantage other people. And the fact that right now, whenever you're feeling pain, you want to lash out at whatever the status quo is because you want to change it, right? So part of it is the last 5 years have been really tough for a whole lot of people. We're in a capitalist system, therefore capitalism must be the problem. And I get all those thoughts, and it's massively imperfect. So I stole the one from Winston Churchill on this one, Phil, and Churchill said, I'll give my version of his words, but democratic capitalism, and the democratic bit's important because it means government is involved in regulating and controlling. Democratic capitalism is the worst system ever tried, except for all the others that have been tried. And so that's kind of the story, right? It doesn't have to be perfect. What we have to remember is there is no better system with which to replace it. And that's important. So what do? We should focus on improving what we've got. Let's make sure regulations are fair. Let's make sure competition is working. Let's make sure political donors and others with a large amounts of sway don't have undue influence on the way our markets operate. Let's make sure that people are looked after. Let's make sure there's an appropriate safety net for people who need that support, who simply can't make it on their own. We're a mature, wealthy, caring society. We need to look after those people. But that together is what, again, I say lowercase capitalism. People confuse capitalism with, free market, anarchy, who cares, survival of the fittest, some sort of Darwinian thing. And it is that at a business level, but at a societal level, it's in the context of our broader social contract and our broader democracy. And that's, if you keep that in the right space, by the way, just not acknowledging the fact, oh, no, capitalism's fine, don't worry about it. You're not going to win anyone over. Again, it's that nuance of, I hear you've got problems. I actually agree with some of the problems. It doesn't mean capitalism is broken. It means it needs to be fixed, not replaced. That's the important bit.
Just getting back to your self-confessed mistake about Webjet, was part of your relaxation about the situation to do with diversification as well?
Oh, absolutely. Yeah, totally. I wasn't selling everything and buying Webjet. And you know what's funny? That mistake was born out of... So when we make mistakes as investors, we've got to be careful not to learn the wrong lessons. In other words, if you get one wrong, don't assume your entire investing thesis is broken. Peter Lynch, one of the better US fund managers in relatively recent history, said if you're good in this game, you're right 6 times out of 10. In other words, whatever you do, the approach you make that actually is market beating or gives you good investment results will still have mistakes in it, because not every circumstance can be done correctly. So my optimism with Webjet was 2 things. Firstly, in the long term, it'll be fine, and optimism wins, and I think that's absolutely still true. The other one was, I looked at COVID and said, well, we've seen, remember SARS, remember MERS, all these acronyms that were these respiratory diseases that originated in Asia. And I kind of honestly at the time thought, well, COVID's probably going to be like one of those. Now, statistically, it's still unusual for a respiratory outbreak to be a once in a century pandemic. Unfortunately, for bigger reasons than frankly just my finances, for people that died and were sick and the economy shut down and lots of bad stuff went on, it was the exception that proved the rule. It was a respiratory disease that wasn't just isolated or low key or never spread or died out. It was one that was ravaged the world. And so I was wrong, I think, even still for the right reasons, Phil, and that might make me just arrogant. Maybe I'm not taking enough blame. But I think in that context, had I bought Webjet where each of those market panics happened, I'd probably be ahead. Now, in the event, it was a silly thing to do. But to your question, it's always about diversification. Speaking of old hoary chestnuts, diversification is the only free lunch in investing. And if you're appropriately diversified, then no one investment, again, appropriately is the important point here, no one investment will bring you down. And you can afford to say, on balance, I'm optimistic. On balance, I like to buy things when they're cheaper than they were, not catching falling knives just because if I liked it at a higher price, I should like it more at the lower price. Quality businesses tend to keep on winning. Those things are true. And so the mistake of Webjet is also the success of other investment selections I've made for exactly the same reasons. And that's why I don't want to learn the wrong lessons. If I said I should never buy anything that's down, I should never buy anything that might have some risk, I should never buy anything that might, something might happen to, then I would be in a world of hurt. Now, I bought, by the way, other companies at much lower prices the month after that in March when things were even lower again, and I got those ones right. And again, I'm not trying to big myself up here. I'm just saying the context is important. We should own our mistakes, we should acknowledge them and learn from them, but also not to learn the wrong lessons. If the lesson of Webjet was don't buy anything when things are down, I would not have bought things later in that month or the next month when there were actually better prices on offer. And those companies did do extraordinarily well after that period, not because it felt good to do it, not because I wasn't worried like everybody else about what happened to the economy, but because I believed the long-term future was probably right.
I sometimes see, because, we're both on X and we see a lot of people commenting on investments and talking specifically about the COVID crash and how quickly it recovered. There were certain people who authoritatively say, okay, I knew this particular moment was the point that the market was going to turn, and they show their reason. Of course, with 2020 hindsight, you're not looking for signals like that, are you?
No, it's nonsense, Phil. Absolute nonsense. It is arrogance, hubris, call it what you want, ego. By the way, the thing I detest most in investors, not as individuals, I don't detest anybody individually, but if I'm looking for attributes that I want to avoid, arrogance and hubris in an investor is absolutely death. I'll give you the inverse example. A couple of significant investors, really well-known people during the COVID crash, sold everything in February and March and said, I won't get back into the market until the pandemic is over. Now, the pandemic took, I want to say, about 2 years to be formally declared over by the World Health Organization, over which time shares were up something like 60 to 70% from those lows. Now, both of those things, to your point, pretending you can in hindsight know exactly when something was going to happen, but also trying to time the market and say, well, I don't think shares will recover until, we talk about politics and the market, same with economics in the market, same with any macro issue in the market, right? What happens in the macro world, share prices improved as the death count increased, the case count increased, as lockdown continued, and as economies fell into recession. The share market improved during that period. Why? Because people took the view that things would get better over time, even despite what's happening right now. And again, that's I know it's starting to sound like a theme of this particular interview, but that was the problem. So those people who said, I know better, I'm going to wait until this is done, and then I'm going to work out what to do, they absolutely missed out on huge gains, probably once in a decade type gains in that sort of time period, because they were trying to judge the market based on these external macro factors, not remembering that the market is a mechanism that looks forward. It says, what is the future likely to look like? And the overreaction that was, to me, frankly, very, very clear, to them wasn't. And I'm not saying I'm a genius. Again, my point is just I invested anyway because I had money to invest. And when I say I invested during the crash, I wasn't mortgaging the house to do it, Phil. I wasn't selling off my firstborn. I just had money that I was saving regularly when I got paid, and I invested that money because it was time to invest that money. I was dollar cost averaging, something I know you've talked a lot about. And it was that was all it was. It was just stay the course, do the right thing, ignore the noise, ignore the headlines and the shrieks and everything else, ignore the pain, frankly, of my portfolio being down a lot, just keep going. And that is, again, invest, add weight, you kind of mentioned at the top. That's exactly what it is. It's that in action right through. And by the way, same this month. And the same 6 months, 12 months ago. And the market's been up and down and sideways over those periods of time. I do it anyway because I think, in my view, it's the very best way to invest.
Okay, let's do some tortured analogies. Now, I'll just I'll preface this by my son-in-law, who's a Panthers tragic, you know. They've had a couple of very good years. Let's think of the Panthers as a company. This year, they've had a bit of a bad start, you know. Mm-hmm. And I'll just point, we've got a little bet going on about how much, and even though we're recording on the 6th, this is going to be we're recording on the 2nd of April, and this will be coming out on the 16th of April. And I believe the Roosters will be playing the Panthers in the coming weekend. And so we got a little thing going on about whether the Roosters are going to beat the Panthers by more than the Bunnies beat them last weekend. Do you have any intel on that?
Well, I'm going to, they say you're only as good as your last game. I'm just going to go back to the previous one. We beat the Panthers in round 2. So I'm going to hang my hat on that one. That might well be the Roosters' best game this season, I've got to say. With the season only hardly underway, it's going to be a tough. It's a rebuilding year for the Chooks, as they euphemistically say. We lost a heap of, I think, 7 first graders in the last year for different reasons. So I've got to say, but, getting back to the analogy though, it's like my son-in-law, hi Brad.
He's invested heavily into the Panthers, after, looking back and saying, there's been a couple of good, well, no, he's a lifelong Panthers supporter, but it's like that. It's an analogy, isn't it? Yes, correct. Some teams are going to do well and other teams aren't going to do so well in the years.
And at different times too. That's exactly the point. And I love sport for this because I haven't taken to single games. If you think about a game of football and your team misses a tackle, you're not jumping ship, and they're not going to necessarily lose because they've got more to come. They make a couple of tackles, they score a try, now they're ahead. Then the other team scores and they're ahead, and that can feel like investing, right? It's the up and down of the market. Now, it's not a perfect analogy because in sport there is one winner every year, and even over long periods of time there'll be one team that has been most dominant over a decade or an era or a generation. The great thing about investing is it's not a zero-sum game. In fact, as long as you're not playing silly things like trying to trade options and derivatives and all that sort of rubbish, it's a positive expected outcome, as the statisticians say. Everyone will make money on average. Now, not everyone makes money, but the market goes up over time. So if I come 2nd or 5th or 100th or, frankly, 2 millionth in terms of my ranking within the Australian investment community, I'm still going to make money, and probably a lot of money. Now, if I come 25 millionth, because I've bet on specky mining stocks and tried to time the market and use leverage and all those sort of dumb things, and I can lose money. I'm not saying no one can lose money. Let me be really, really clear. You can lose money with shares, and people do. But if you're sensibly diversified, you have a long-term view, you invest regularly, you give it enough time, the odds are very, very good you'll make money. And if you beat the market, which I'm trying to do as my day job and my portfolio, then great. If I only get the market return, that's almost as good. If I even lose to the market over 50 years, I'm still going to make a lot of money if I'm investing regularly. So that's why you're right about the analogy. I don't want to diss your analogy, but what I do want to point out is even in that context, while it's useful to use sport a lot as analogies in investing, most will win. In rugby league, we don't assume that if 12 of the 17 teams are winners and 5 are losers, and yet in investing, it's probably going to be something like that, and probably even more than that if you do those very sensible basic things. And not everyone does, and there's no guarantees, but if you do them, you're very likely to win anyway. You might come first, but you'll have much more money. Think about that index chart I mentioned. You'll have much more money by investing regularly, letting it compound, being diversified, all those sensible things when you finish. So, the rugby league, someone wins, and, the runner-up is the first loser. When it comes to investing, almost all of us win almost all the time.
Scott, do you ever look at overseas markets, or are you mainly concentrated in the ASX?
No, I do actually. About half of my portfolio by value is invested either in the US directly or via ASX-listed US ETFs. So yes, I'm a big fan of the US market. Most of my investing is done here, but by weight, about half of my money is invested in the US. And I'll separate that for a second, just as a quick aside. Firstly, I use ASX listed ETFs. So, I'm not doing any active stock picking to make those decisions. I own a Vanguard World X Australia ETF. I own a NASDAQ ETF. My young bloke, I've got a little bit of money put aside for him. He's invested in the Vanguard US Total Market ETF. So those are the ETF-based investments. So I don't spend a lot of time picking the stocks in the US. My personal portfolio, I own a very large amount of Berkshire Hathaway proportionally. I mean, large amount, I'm not sure I'm a big note myself, but proportionally, Berkshire's about 2/3 of my US portfolio. Amazon's probably another 15% or so, which, by the way, would be stupidly concentrated, except I don't just look at my US portfolio, I look at my total portfolio, and also Berkshire's Berkshire. So no guarantees will do fantastically well, but I feel very good about owning the shares. But I do invest over there. I said, not particularly actively. I buy really rarely, but I think sensible diversification to overseas markets, either directly or via ASX listed US ETFs, I think is a smart approach.
So speaking of ETFs, would you recommend ETFs over single stocks for beginners getting in the market if they, say, got $1,000 to start their investment journey?
Yeah, I really would. I'm a stock picker by trade, by the way. If I work for any other company that does this, I'd have to say, no, buy stocks. No, start with ETFs. In fact, we've got a service called Motley ETF Investor for that reason, something I wanted to roll out, and I was lucky enough to get the boss to agree. ETFs are wonderful, wonderful, wonderful things. So I think there's money to be made stock picking if you're good at it, you want to do it, and you have an aptitude for it. But for most people, you don't need to. You probably shouldn't, frankly. Why? Because the market, I believe, will continue to do what it's done in the past, which is go up over time, 8 or 9% a year on average over the long term. Let me put those disclaimers in. And if you can get that result with a tiny, tiny, tiny fee, 0.04% or something, 0.07, like fractions of a percent. If you can get the market return with a fraction of a percent in fees and compound that for a long period of time, you're going to do really, really well. And if you're getting started, the benefit of an ETF is instant diversification. If I say I've got $1,000 now, I'll buy shares in, I'll pick a company, Woolies, just for the fun of it, and those shares fall 30%, a few things are going to happen. Firstly, you're not diversified, so you've got to take the full loss. Secondly, you're going to feel like investing sucks, and it's a terrible idea, I should have done it. Doesn't mean ETFs can't fall, by the way, but individual company risk is far, far larger than that. And then it takes a longer time to build a diversified portfolio. So yeah, I would absolutely start with an ETF or range of ETFs. We've got, and this is not a plug, mate, I'm not going to do it, but there's 4 individual ETFs. We've got this in that ETF investor service. Like here's a sensible diversified ETF portfolio, 4 ETFs, knock yourself out. That's as much as you need to do. Now, I do think, I invest in individual stocks. I think you have the opportunity to do better than that if you put some time and effort in, you understand business and you want to have a go. Doesn't mean you will. Maybe you'll try it and go, yeah, I sucked at it, it's not for me. That's okay too. So I think you can, add to your ETF returns with good stock picking, with good company analysis and valuation, but you don't need to. ETFs are perfectly fine for almost everybody. There's no one should feel like they need to, that somehow the smart money buys stocks or that somehow there's massive gains on offer that they can't get. Yes, Warren Buffett's made a fortune by investing in individual companies. I'm not Warren Buffett, you're not Warren Buffett, our listeners aren't Warren Buffett. I have so far been able to beat the market with my individual stock selections, but that's maybe I wouldn't have. Maybe I could have done better doing something else. But ETFs are wonderful things. I'm a massive fan. Can I add one quick but to this one, Phil? And that is, ETFs used to be the generic name for an index fund that was listed on the stock market. That's how the first ETF, because exchange traded fund. There was an index fund, it was listed on an exchange, then it becomes exchange traded, hence ETF. They are wonderful. So I'm talking here about broad, index-based, low-cost ETFs. Those 3 phrases are important: broad, index-based, low-cost. The problem is now anything can be an ETF. You and I could start the Shares for Beginners / Scott Phillips ETF, and we could take on $1 million in debt and go and buy crypto coins. And that would be an ETF. It was a fund that was traded on the exchange. So what I want your listeners to know is not all ETFs are the same. Please, please, please don't get sucked into the exciting, this theme, this investment idea, that leverage, that view on the market. I'm talking about the plain vanilla stuff, really plain vanilla. Invest, add weight. Vanguard, BlackRock, there's a few of them. Most of the ones I own are almost all Vanguard. Just basic, plain vanilla. They track an index. They're a broad index, by the way, not a little tiny index, but a big one like the S&P 500, NASDAQ, the ASX 300. Buy that and keep your costs low, diversify that way. So ETFs, absolutely, but those ones in particular, don't go and grab the cybersecurity ETF and think you've got a diversified portfolio or the bear double leveraged, whatever it is. That's all product stuff. They create those because they suck you into wanting to buy them. That's not how you should invest. Start with what should I want to try and do, and that is mirror the market return, keep my costs low.
Yeah, I think it's worth pointing out that many ETF providers do spend a lot of time trolling social media and trends to see what people are talking about, and then they'll create a fund based on that because it's a marketing exercise for them to make some money as well. So don't get sucked in.
Of course it is. Well done. Yeah, well said.
Okay, so I think it's also worthwhile that if you're going to be wanting to choose individual stocks, you've got to be passionate about it. It's not something that you just do for a couple of weeks and think you're going to make a lot of money. It's just something that you've got to be in for the long term. You've got to be passionate about it. You've got to like to read numbers and read company reports and follow it up. And I just wanted to point that out because some listeners are going to be taking that step and they're going to be suited for it because they will be imbued with that passion. But most people, as you say, just stick with ETFs.
And that's the great thing, mate. Back in the day, you couldn't do this. The ETFs didn't exist. It was really hard for an individual investor. The index fund itself is only 50-odd years old, which is old if you're a young person now, but not that long ago. And frankly, the first ETFs, I did the numbers, it was something like 2010s or something. It feels like they've been around forever, but they really haven't been around that long. And back in the day, you had to say, well, I guess I'll buy some BHP and some Woolies and some CBA and I'll throw some old names in, some Elders and some, HAH or something. And you kind of had to build your own diversified portfolio because you couldn't do it easily on the market. There are some individual fund managers that give you something similar. And listed investment companies have been around for a while. That was the other way you used to have to do it. But the invention of the ETF is just such a great thing. And I love your point about being passionate about it, Phil, because if you don't want to pick up the AFR, if you don't want to read the business section of your local newspaper because it just doesn't interest you, then please don't invest in individual shares. Grab an ETF. Like the ETFs will do you. I kid you not. The index chart I talked about, by the way, that's the index. That's not stock picking. You got a 13-fold return just by buying the index and going fishing. And in fact, it'd be better than that because the 13-fold return is one investment at one day, and then waiting 30 years doing nothing else. It does include reinvested dividends, but it doesn't include any money you add to your portfolio over that period of time. And so I hope what I'm pointing out pretty clearly here is if you can get 13 times your money just by buying an ETF. If you get even more than that, well, not in percentage terms, but if you can add more money on top of that because you're adding regularly to an ETF, that is literally, as long as you're investing regularly, that has to be a large enough amount of money. If you're investing $1 a year, I'm not going to make you rich, right? But if you're investing a reasonable proportion of your income, if you can live below your means a little bit, invest the difference in broad index ETF or a couple of them, maybe an Australian one and a global one or something, and you do that for a long enough period of time, you'll be very, very, very well off. You'll be completely fine. And that's kind of the key message. So, yeah, by all means, if you want to go and say, hey, do I think Woolies is a great investment? If you have the interest, the passion, as you say, the aptitude, if you're not mathematically minded, probably don't do it. Not because you're not a worthwhile person, just because this particular pursuit rewards mathematical mindedness. Now, I built a very bad chicken coop during the GFC, during the COVID crash, while we were all in lockdown. But I'm not going to be a carpenter. Not because, and if someone said to me, look, Scott, unless you're good at this and you love it, maybe don't become a carpenter. I'd be like, yeah, you know what? That's probably right. I'm better, unfortunately, for everyone sitting at a desk tapping on keys rather than wielding a hammer. I just don't have that aptitude. And doesn't make me a bad person, nor it makes the carpenter who doesn't want to invest in individual companies a bad person. It's just horses for courses. Stock picking is a pursuit for those who are passionate, I love your word, who are keen, who have the aptitude, who are interested, who are going to put the time in, and who have the stomach for that volatility potentially and being wrong sometimes. If that's not you, either get your own carpenter or I don't know what the ETF equivalent is in chicken coop manufacturing, but if I could find it, that's the analogy I'd throw in right now. But yeah, horses for courses. If it's for you, do it. If it's not, the ETF will do you perfectly well. You won't lose a minute's sleep, hopefully.
Any thoughts on Bitcoin? Now, I'll just preface this by saying I know you've had many conversations with Andrew Page, the straw man, who's a great Bitcoin believer. And I think psychologically there's this thing where if people ascribe a value to something, it has value. I mean, really, has gold got any value? It's just a shiny metal. And without understanding all of the nuts and bolts of Bitcoin, I think that so many people are ascribing a value to it now that it does have value. But anyway, your thoughts?
So I think you've set it up beautifully. I am on the fence on Bitcoin. I would not short it and I would not buy it. And it's not investment grade for me.
Not even just a smidge of it, a little bit.
Nah. And here's why. Well, firstly, the reason why not just smidge is opportunity cost. So if I have things I actually have conviction in, and I'd buy Bitcoin just because maybe it might go up, for me that would be inconsistent with my investing approach, which is I want to invest in things I have the greatest conviction. I've only got $100 to invest, and invest that in the things I think I have the most conviction in for future value creation. Maybe Bitcoin's one of those, maybe it's not. Maybe a specky miner is one of those things. Maybe a punt on the horses is one of those things. I don't know, and I'm not trying to be, again, pejorative about Bitcoin, but I don't have enough money that I can throw money at everything. I'm going to pick my best ideas and invest in those things. But the reason I'm not bullish or bearish on Bitcoin is because of exactly what you said. It's the ascribed value. Now, we know what the current ascribed value is, same as we know the current ascribed value of any share price, right? Woolly shares are worth, in air quotes, the value that they trade at today. Now, you and I have been around long enough to have seen companies that are horribly undervalued for a long time that finally started to go up in price. And the ascribed value when they were undervalued was too low. When they got to a reasonable price, because the market all of a sudden understood the company, then all of a sudden you have a fairer value. The same is also true in reverse. We've both seen companies where the market gets super excited about something. Lithium stocks, by the way, is a great example over the last couple of years. Oh, it's obviously worth this price. Fast forward, it's worth now 85% less than that price. Now, people thought it was worth a price at that time. They now think it's worth a lower price. They both could be wrong, by the way. It could be somewhere in between. But my point with Bitcoin is I can't assess, because Bitcoin doesn't produce, like gold, doesn't produce anything. There's no income, there's no dividend, there's no profits, there's no revenues, there's no cash flow. It just is. And that's not bad. I'm not criticizing it. I'm not bearish on it at all. But we are relying on, if you buy it today or hold it today, you are saying, I think people are going to pay more for it in the future. Now, you can have a very good thesis for that. But I challenge anyone to make the case to justifiably say, with a level of conviction and a level of, proof's the wrong word because there's no proof about the future, but some sense of, here's why I think it'll be worth more. Now, if you think it's going to be worth more, buy it by all means. I don't think it's going to be worth more or less. I just don't know. For all I know, this could be the next Tesla, right? Or it could be the next, what's a big company? Next, I was going to say Enron because it's fallen a lot. But that's not fair. It was a fraud. What was really expensive? I don't know. Maybe it's the next dot-com boom of the 1999s, right? It doesn't mean they're worth nothing, but is it overpriced right now? Is it underpriced right now? And most importantly, how can you possibly seek to know without any income, without any revenue, without any profit, without any market share, without any production of something? It's impossible. All you're speculating on is that more people in future might want it, or more people in future might not want it. But I can't handicap those odds, Phil. So I'm not bearish on it. I wouldn't short it, but I can't invest it on that basis. And particularly for our members and other people who listen to me as an investor or an investment advisor and say, oh, Scott thinks this, I find it really hard to say to someone, you should buy Bitcoin because I think it'll go up. Because the why is so rubbery. Now, again, I can't say it won't go up either, but that's why I am not an investor in Bitcoin. I won't be buying any Bitcoin anytime soon. If I do, it'd actually be a speculation. And the speculation would be, this thing's got cult-like following, and there are more members joining the cult every day, and whatever that's true, there's upward pressure on the price. I think that's a perfectly good speculation. And I don't mean speculation pejoratively in this case. I literally mean you can say, I think more people are going to use this thing, and if they do, the price should go up, then I should be able to buy it. But for me, an investment is valuing something on its intrinsic value, not just the fact that more people might like it in the future.
I know you're passionate about doing the right thing. Do you ever take into consideration governance when you're looking for companies to invest in and corporate behaviour?
That's such a great question. Yes, a lot, but not in this will annoy some people at the ASX and ASIC, not in the way that the rules are normally set down. You know, rules and laws are set for lowest common denominator because you have to put a line somewhere. And one of my great criticisms, I will get to what I do look to, one of my great criticisms is, for example, Warren Buffett, who's been at Berkshire for 60-odd years, and Jerry Harvey, who's been at Harvey Norman for 50-odd years, are both considered to be not independent. And ASX would say, if you're too many people like that, you should get rid of some of those people off the board because they're not independent. And I think that independence is really, really wrong-headed, because does anyone care more about Harvey Norman than Jerry Harvey? Does anyone care more about Berkshire than Warren Buffett? And in fact, if Buffett, who has, I think literally everyone on the board of Berkshire Hathaway has massive amounts of money invested in Berkshire shares. Now, by the letter of the law, Berkshire is doing the wrong thing, or not law, the guideline, and should get rid of some of those people who care deeply about the company, who know the company well, who've been around for years, whose wealth is absolutely tied up in it, and get some people off the street who might have a great degree or a qualification or have worked in another company or done something else but have no shares in Berkshire Hathaway. Now, I want the people at the top of the tree caring so deeply about the value of the company, the long-term value of the company, that they're invested in it. So I don't think that's particularly useful. As an example, there was some talk about kicking people off the boards of banks after they've been around for more than 10 years. And again, arbitrarily, if I don't know, pick your favorite banker who's been there for 11 years has to leave the board just because of some arbitrary time frame. I think those are really, really unhelpful guidelines. What I do think is important, though, is the things that matter when it comes to governance. So we want people of massively high reputation. I want people with skin in the game. I want people who are invested in the company. I want people who are honest and candid with us. I love founders or founding families involved in the management of the businesses because, again, they care more than most about the future of the company. They're not there clicking a director's fee and ticking a box. They desperately care that their legacy is followed through. So I really do care about governance. I think it's really, really important. I will flag one thing that we've seen over the past couple of years, the last 12 months. Two companies, WiseTech and Mineral Resources. We've seen both major figures, founders of both, get themselves into some trouble for things they've done inside and outside the company. Now, I say into trouble, I'll say allegedly a lot here because very little has been proven. There have been some admissions made in some cases, but I won't go into detail because I don't want to get you or my own trouble, Phil. But what we've seen is investors who've said, actually, you probably did the wrong thing, or at least I'm not sure you've done the right thing, but I'd like you to hang around because you create a lot of value. And so this is a really, really sticky one. I don't have a really good answer for you, Phil, honestly. At WiseTech, the shares went up when Richard White came back to the company, or announced he was staying with the company. At Mineral Resources, Chris Ellison has effectively been...
These are people who've generated fantastic shareholder returns as well.
And that's the question, right? So you think, okay, well, how bad is the governance? And there's a really, really messy, almost a bit icky kind of, sort of talk about capitalism, right? This is the real question: is do I want people who tick the boxes and are whiter than white and have done the right things and have, never crossed a line? Ideally, yes. But if those people make me less money than someone who maybe isn't the person I would want to have around for dinner, but or maybe has done the wrong thing by the company allegedly in some cases, but has still created even more value than has been destroyed. And that's a really, really difficult question where you've got to say, morally, I want people running companies and in positions of power who are squeaky clean. Why? Because it's the right thing. At a commercial, at a, we'll call it mercenary level, I want to make money with my investments. Now, I'm not justifying anyone who's broken the law. Let me be really, really clear. I'm not saying that money should come for everything else. I am saying if I'm investing in a company and the people who are running that company can create value for me, despite their failings, let's be honest, we've all got failings, do I want them there or not? Do I trust someone who's been doing the wrong thing? Do I trust they'll do the right thing moving forward? I don't know. Maybe they're chasing it and maybe they will. Or maybe, fool me once, shame on you, fool me twice, shame on me. But yeah, it's a really, really difficult one, mate. I prefer to have quality people running businesses who are committed to and trying desperately to strive for good quality corporate governance. But again, I mean that lowercase c, lowercase g, doing it well, not just ticking boxes that regulators put out because they kind of have to have some standards somewhere.
Scott Phillips, thank you very much for joining me today.
My absolute pleasure. Thanks for having me, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player or tell a friend who might want to learn more about investing for their future.